Welcome to This Explainer. If you've ever felt totally overwhelmed by all that Wall Street jargon, or the constantly flashing red and green numbers on a screen, you are absolutely in the right place. Today, we're going to demystify the stock market once and for all. We're cutting through the noise and building you a clear, actionable toolkit so you can start building wealth safely and smartly. Let's dive in.
We've got four main pieces to build this toolkit today. We're going to cover exactly how the market works, reading charts, fundamental analysis, and finally, the common beginner mistakes you absolutely must avoid to protect your money.
All right, Section 1. Let's talk about how the market actually works.
So at its very core, the stock market is literally just a marketplace. It's really not that different from your local farmer's market or even eBay. But instead of buying, say, fresh vegetables, people are buying and selling tiny pieces of real, living companies. When a private company wants to raise a bunch of money to grow, it goes through what's called an initial public offering, or an IPO. Basically, it splits itself into millions of little shares. And after that IPO happens, those shares get listed on public exchanges, and investors just freely trade them among themselves, based entirely on supply and demand. The company itself already has its money. The daily trading you hear about is just everyday investors swapping ownership.
Let's put this into perspective. Think of a local pizza shop owner who needs $100,000 to open up a second location. Now, instead of taking out a massive bank loan where he'd be forced to pay back principal and interest no matter what happens to the business, he decides to sell 1,000 shares to investors at $100 a pop. He's trading partial ownership for cash. The catch here? Well, if the pizza business doubles in value, the investor's share value doubles too. But if the business goes under, those shares become completely worthless. They share the risk, but they also share the reward.
Now, because millions of people are making these risk and reward calculations every single second of the day, prices are constantly shifting. When the overall market is rising and the vast majority of investors are feeling super optimistic and eager to buy, we call this a bull market. You can picture a charging bull, right? Thrusting its horns upward into the air.
But conversely, when fear takes over, maybe some bad economic news hits and people rush for the exits to sell, prices drop. We call this a bear market. Think of a bear swiping its massive paws downward. But hey, here's the absolute most important takeaway to remember for this whole section. Historically speaking, the US market spends significantly more time in optimistic bull markets than it ever does in fearful bear markets. Patience really does pay off.
Okay, moving right along to Section 2, reading charts.
Once you grasp that the market is entirely driven by supply and demand, you need a way to actually visualize a stock's price history. You want to be able to spot the patterns that tell you what everyone else is doing, and the absolute go-to tool for this is the candlestick chart. A single green or red candle doesn't just give you one boring price point, it gives you four crucial pieces of data all at a single glance. It shows you the open price when a time frame started, the close price when it ended, and those little lines or wicks stretching out, those show you the absolute high and low of that period. A green candle simply means the price went up, and a red one means it went down. Pretty simple, right?
Now, the real magic happens when you zoom out and look at a bunch of these candles together. Patterns start to emerge. If you connect the low points on a stock's history, you'll spot what we call a support level. Think of this as a price floor. It's a spot where buyers consistently jump back in because they think the stock is a total bargain. On the flip side, connect the high points and you'll find the resistance level. That's the ceiling. It's the price point where sellers usually look around and say, all right, great time to cash out and take my profits. Knowing exactly where this floor and ceiling are is an absolute game changer for timing when you buy or sell.
Up next, we have Section 3, fundamental analysis.
So charts are great for showing you what you pay, but fundamental analysis, that shows you what you're actually getting. We have to stop just staring at squiggly lines and start looking under the hood at a company's true financial health. And to do this, you've got to understand the difference between revenue and earnings. Revenue is that big, flashy number, the total amount of money rolling into the business. But earnings is the cash actually left over after all the bills, the payroll, the raw materials, all of that is paid for. A business could easily have $1 million in revenue, but if their expenses are $990,000, they only have 10 grand in true earnings. You absolutely need to know both numbers.
To figure out if a stock is actually a good deal based on those earnings, we use something called the price-to-earnings, or PE ratio. Let's compare two imaginary businesses, Restaurant A and Restaurant B. Let's say both of them make the exact same annual profit of $1 million, but Restaurant A only costs $5 million to buy, which gives it a PE of 5. Restaurant B, on the other hand, costs $30 million, giving it a massive PE of 30. So restaurant A is clearly a way better value. You're paying a fraction of the price for the exact same amount of profit. That, right there, is the magic of the PE ratio.
But listen, a low PE ratio isn't the whole story. We also want to see growth, right? When you can combine a reasonable price with consistent revenue growth, that's when you really strike gold. Just look at Amazon. They managed to grow their revenue from $61 billion in 2012 to well over $500 billion just a decade later. When you spot a business with underlying fundamentals showing that kind of relentless, consistent growth, you've found the kind of stock that can actually justify enormous, market-beating returns.
All right, our final stop today is Section 4, Avoiding Common Beginner Mistakes.
Because let's be real, all the technical and fundamental analysis in the world won't save you if you fall into some basic behavioral traps. So let's put the protective roof on our investing toolkit. The absolute first trap: buying purely based on social media hype, without checking a single actual financial number. We saw this play out perfectly during the 2021 Reddit frenzy with GameStop. Beginners watched the stock rocket up on social media and bought in at near $400 a share, purely out of FOMO, fear of missing out. The company's actual fundamentals hadn't magically changed overnight. It was 100% hype. And the second that hype evaporated, the price crashed hard, leaving those late buyers with catastrophic losses.
You also absolutely have to avoid panic selling. Look, when the market suddenly drops violently, like it did during the COVID crash in March 2020, it is terrifying. I totally get it. But the investors who panicked and sold at the bottom, they permanently locked in those massive losses. Meanwhile, the market actually fully recovered and hit brand new highs just a few months later, which ties perfectly into our next big mistake: trying to perfectly time the market. If you sit on the sidelines just waiting for a crash so you can buy in, you are going to miss out on huge gains. Always remember this: time in the market beats trying to time the market every single time.
And here is a non-negotiable rule for your financial survival. Never, ever put all your savings into just one single company. I don't care how much you love the stock. Back in the late 90s, Enron was literally one of the most admired companies in America. People had their entire life savings tied up in Enron stock. Well, when the company collapsed from massive accounting fraud in 2001, those people had their entire wealth completely wiped out in a matter of months. Diversification is your ultimate shield. Please, don't skip it.
Now, let's talk about a silent killer for a second: hidden fees. Consider the massive gap between two different investors over a 30-year period. Let's say they both start with $10,000 and they both get the exact same overall market return. But investor A uses a fund with a seemingly tiny 2% fee, while investor B chooses a low-cost index fund that charges just 0.03%. That quote-unquote tiny 2% fee quietly eats away at compounding interest for decades, leaving investor A with only $43,000, while investor B walks away with a whopping $77,000. Seriously, keep a very close eye on your fees.
Our final mistake to cover today is actually purely psychological: checking your portfolio every single day. Studies have shown over and over that the more you obsess over those totally normal daily fluctuations, the more emotional you get. And when you get emotional, you are way more likely to make an impulsive, foolish trade. The legendary investor Warren Buffett really has the perfect antidote for this. His advice: buy great companies and then simply do nothing. Believe it or not, your patience really is your greatest asset in this game.
So, as we wrap up, I want you to take this blueprint, start applying it to your own investing journey, and ask yourself a very serious question. Will you let patience, solid fundamentals, and discipline build your wealth over time? Or are you going to let social media hype and daily panic tear it all down? You've got the tools now. How you use them is entirely up to you. Thanks so much for joining me for this explainer, and hey, happy investing.